Hello students, how are you? I hope you're all fine. This is Kai Johar, your financial management tutor in this practice to pass session conducted by ACCA. Let me introduce myself a bit to you people, and then we will start with our today's work, day one's work. So I passed my ACCA exams back in the year 2002. So it has been more than 19 years since I passed my exams. And I'm teaching ACCA students and other qualifications since last 20 years. And I teach subjects like financial management, financial reporting, management accounting, and I teach other subjects as well, like audit and all. So I'm teaching in Karachi at an institute named Alhamd Academy since last 15 years. Since 2004, I'm teaching there. Okay, so thank you very much to ACCF, first of all, for giving me a chance and giving me an opportunity to deliver my lectures to you people. And thanks for you as well for joining this session. And I hope and I wish you all the best that you pass the exam in the first session. And I hope and I expect that you will work hard and until the exam occurs, and you will be doing your best of efforts to pass the exam in the first attempt. So thank you very much again, students, for joining this session. And our topic for day one is investment appraisal. So uh, in investment appraisal, various areas have been covered in this financial management syllabus, and this involves calculating net present values. We will be covering all these topics which I am listing right now in today's session, and we might remain undone with a few topics in the end, which will be covering in the tomorrow's class, right? So tomorrow's session will be on a cost of capital and a bit of today's, if it remains. Okay, we'll try to do it today only, today's work. So first of all will be let me list down the topics which are covered in investment appraisal. So calculating NPV, calculating payback period and discounted payback period, evaluating projects under capital rationing, asset replacement decisions. That this topic includes in how much time should we replace our assets, like in 4 years, 5 years, and how much time we should replace them. And then lease or buy decisions, then evaluating projects under risk and uncertainty. These are the 6 topics which we are going to cover under this topic, investment appraisal. So we will be doing a lot of practice of questions, case study type questions, and constructed response type questions today, and in a short while. And before starting, I want to make a few announcements so that you can comfortably work with me. So first of my announcement is that I'm sharing a worksheet. So you must be seeing a worksheet being displayed on the screen right now. And this worksheet will work as a worksheet will work as a whiteboard for you people, which is usually used in the classroom. So I'm not able to use a whiteboard, so I'll be using this worksheet, and I'll be writing my answers and workings on this worksheet. And side by side, left hand side, on the left hand side, you are being able to see the questions as well. And on the right hand side, I'll be doing the workings and giving the answers to those questions, right? So you will be looking at the worksheet, and the question on display, question 1, is Bell Company, right? You must be able to see that. So now let's start. Let me tell you a few more things, a few suggestions to you people before we start. So the first suggestion is please keep your calculators and notebook ready with you people, so that you can note down the workings appearing on the screen and keep using your calculators also together, so that you can learn effectively with me, right? So now let's start with this question, Bell Company. So first I would like you people to go through this question and read it properly before we start doing the requirements of it. So this is a case study question, Bell Company, and once you read the questions, once you read this question one, five objective type question will appear in front of you. Let me show you. So you must be seeing the requirement A, B, C, then D, and E as I'm scrolling the screen. So these are the five questions which are to be answered by us on this question, right? So first, please go through the question, read out the question first, and then I'll be starting with requirement A, B, C, D, and E, the five questions. And this question is of 10 marks. So this is a section B type question, which we are going to do right now. Okay, so students, please read the question. I'm waiting a few minutes for you to comfortably read the question, and then I'll be starting it. So I'm waiting for you people to read the question. Okay, students, let's start with our first objective type question, question A. So it asks, what is Ding's money discount rate? So in order to calculate the money discount rate, we will be using a formula. And that formula is 1 plus R. R stands for the real rate, multiplied by 1 plus I. I stands for the general inflation rate. So there can be many inflation rates or price increases rate in the question, but you are going to use the general inflation rate in the economy, right? Minus 1. And this will be multiplied by 100 in order to arrive at the money rate. Now, money rate is the discount rate we use to calculate the present values. And the money rate includes the effect of inflation. there are two types of rate, real rate and money rate. So real rate has been given in the question and we have to calculate the money rate. So let me show you where they have given you these information regarding DING. So they are giving you the real discount rate. So you can see I am underlying it with green. This is the real rate being given, and they've also given the general inflation rate in the question, which is 2%. So now we are in position to solve this question. So 1.05 multiplied by 1.02. Please use your calculators. Minus 1 and then multiplied by 100. This will give you the discount rate which is expected from you. And the answer to this question is 7.1%. So the correct answer is A. So 7.1% is the correct answer to this question. So A is the correct answer. Okay, let's move on to the next requirement. What is the present value of Dong's last payment that will be made in 4 years time to the nearest thousands? So there is a blank over here, there is a box, we have to fill in that box and we have to calculate the present value that will occur in 4 years time. So let's find out where the things are given related to Dong. So I'll be highlighting the important facts required to solve this question by green. Look, 1,20,000 is the first installment, is the first lease payment. This will occur in the first year. And then the question says that the payments will increase by 4% per annum. Like in the second year, 4%, third year, 4%, and fourth year, it will also increase by 4% in the fourth year. And the DING's cost of capital is 8%. So we will discount it using an 8% rate. So students, let's first calculate the fourth payment. Fourth payment is not going to be 120,000. Fourth payment will be rising from 120,000 in year 2, year 3, and year 4, and then we will calculate the present value of the fourth payment. So let's first calculate the fourth payment amount using 120,000 and the 4% increase rate. So 120,000 multiplied by 1.04 to the power 3. and then this gives you the payment amount in the 4th year. So the payment amount is going to be 1,34,984. Now let's calculate the present value. So the present value is 1,34,984 multiplied by 1.08 to the power minus 4, as the payment will occur in 4 years time. So 1,34,984 into 1.08 to the power minus 4, this gives you the present value, and this will be the answer, which is 99,217. So the question asks for the payment in the nearest thousand. So in the nearest thousand, you will be putting 99 in this block. So as they have already put 3 zeros over there, so you'll be putting 99,000 in this block. So this is rounded off to the nearest thousand. So our answer is 99. Okay. Students, I hope you are using your calculators together and making the notes as well. Students, I will be sharing this sheet as well, on which I am doing these workings with you people afterwards by the end of this webinar. Once we complete with our all 5 sessions, I'll be sharing the sheet with you. So you will be having all these workings and questions as well. So you are also getting the question sheet for today, day 1, on the right side of your panel, in the webinar panel. F9 practice to pass day 1 document you are being able to see there, and you can fetch it from there. Okay, students, let's move on to the next part of this question, which is requirement C. So now the next requirement is, what is net present value of Merrill's project? So let's calculate the net present value for the Merrill's project. Now see what they tell you about the Merrill project in this question. So you can see this paragraph, which I am highlighting in green. This is all about the Merrill's project. So according to the question, they have given you 3 years cash flows, year 1, year 2, and year 3. There is an initial investment of 1 million, which is to be evaluated whether to make an investment of 1 million or not in this question. And these are the cash flows. Outflows 1800, 2500, and 1500. These are in the real terms. Real terms means in the present day prices. These are not inflated cash flows. So first, in order to calculate the NPV, we have to adjust them for inflation, and we have to take the cash flows in the future prices, right? So what they say in the question, it is expected that outflows will rise by 3% per annum. So these are going to rise by 3% per annum, the outflows, and the inflows are to rise by 2% per annum. So first we have to adjust these cash flows by 3% and 2%, right? And then we will calculate the present value at 9%. So students, let's start doing the calculation for this. So first we will inflate these cash flows. So moving on to our working. So let's make an NPV working. So this is a 3-year project. So I made 4 columns, one for year 0, one for year 1, 2, and 3. So about inflows, let me make a working. So the first year inflow was 2000. I have to increase this by 2% as the inflation rate is 2%. In the year 2, the cash flow is 3000 inflow, and I will have to increase it by 2% 2 times, because 3000 is in the present day prices. So first time 2% price increase will be in the year 1, and then again the price will increase by 2% in year 2. So I have to take power 2 over here. Okay, then in year 3, okay, in the year 3, the cash flow was 2000, and the price will increase 3 times. So 2000 into 1.02 to the power 3. So now multiply 2000 into 1.02, then in the year 2, 3000 into 1.02 to the power 2, and then 2000 into 1.02 to the power 3. So this gives you the cash inflows. Now let's move on to the cash outflows. The first year's cash outflow was 1800. So 1800 will have to be multiplied by 1.03. Then in the second year, the cash outflow is 2500, which will have to be multiplied by 1.03, and this time we have to take the power 2, because the price rise will be first of all in the first year and then in the second year. So the next year's cash flow, third year's cash flow is 1500 multiplied by 1.03, and power will be 3 years this time. So this gives you the cash outflows. So you'll be able to see the workings as well about the cell on which I'm writing the cash flows, the present values. So please keep using your calculators. So there you get the present values. I have rounded off the present values in the nearest thousands, and now we will deduct the cash outflows from cash inflows, and the initial investment was 1000. So moving on to the net cash flows. NCF stands for net cash flows. Deduct the net cash outflows from the inflows in order to arrive at the net cash flows. So there we go. Now we arrive at the net cash flows. Now we'll calculate the present values, right? So in order to calculate the present values, use the present value fraction. Present value fraction is 1 plus r to the power minus n. So for the year 0, present value fraction will be 1. For year 1, the present value fraction is at 9%. We'll be taking at 9%. So 1.09 to the power minus 1. We will take the present value fractions. These are present value fractions are taken up to 3 places. There you go. You get the present value fractions. Now multiply the net cash flows by the present value fraction in order to get the present values. So net cash flows multiplied by the present value fractions, this gives you the present value. So present value of the initial investment remains at minus 1000. First year net cash flows present value 171. Second year's cash flows present value 395, and third year's cash flows present value is 373. Now adding all these 4 items. Now add these 4 items. 373 plus 395 plus 171 and minus 1000. This gives you the net present value, which is negative 61,000 negative. So we should not invest in this project if you think about it financially. So answer to our question, the part C, the requirement C is D. D is the correct answer to this question. NPV negative 61,000. So students, you can please note down. I'm waiting for a minute so that if someone has to complete the noting work, they can do it. Use your calculators also to arrive at the workings. We have started with the question directly because in this workshop, I'm taking some questions I'm having some question on the chat. So when I'm doing workings, usually it is difficult to answer simultaneously. So I'll be answering the question once I complete my workings. Okay. Okay, I'll be discussing the theoretical area as well of the investment appraisal aspect. I'll be discussing a bit about it afterwards, but let me tell you what you need to do in the theoretical area. You need to know the advantages of using the net present value and disadvantages, and you need to know the strengths of net present value. Secondly, you need to know the strengths of internal rate of return and weaknesses of it. You need to know the strengths and weaknesses of using the discounted payback and the simple payback period. So these type of questions you should know. Then in topics to come ahead also, I will tell you about what theoretical things are required to be learned by you people in capital rationing and other areas coming up in like in risk and uncertainty. So we will be doing some theoretical questions as well in this session. Please wait for it. So this question was from Hiskil Ahmed. Then some of the people have also answered this question. So thank you very much, and it's great that you people keep answering the questions. Okay, the material is placed on this control panel of webinar. So Rida, you can get the F9 practice to pass day one document. It's a Word document over here, and this Excel sheet will also be provided to you in the future once we complete with these 5 days, right? So you'll get it this sheet also. You may get it earlier as well. Okay. I stands for the inflation rate, and R stands for the real rate in the formula which I have given, and M stands for the money rate. So they have asked you for the money rate, so I've calculated the money rate in the first part. Yeah, the discount factor is basically 1 plus R to the power minus N. This is the discount factor, and the cost of capital is the percentage, 9%. So 9% is the cost of capital, and the discount rate is 1 plus R to the power minus N, which has been used. So in this question, the part C, the discount rate was discount factor was the discount factors are these ones: 0.917, the present value factors which I have written over there. So 0.917, 0.842, and 0.772, and the cost of capital is 9%. We are not taking power 4. One of the question Rohit asked that why we are not taking power 4 in the part B. We didn't take power 4 due to the fact that they have given 120,000 in year 1, and thereafter it is rising. In the second year, one time; third year, second time; and then in the third year, third time. Okay. So students, I'll be answering question at various times. Sometimes it is difficult to answer all the questions during the this webinar. So I'll be I'll be answering your question after the workshop as well through the group. Okay. So students, that's all for the chat from the chat area. So let's now move on back to the question. The next requirement. So over here in part D, now let's move on to the requirement D. Okay, see the alphabets I'm writing in red. So the answer to the question C was D. D for delight. Okay, so now next is part D. Let's move on to the the question D. So when considering risk in project appraisal, what is the main advantage of using simulations to assess the appraisal? So the advantage of using simulation is that more than when more than one variables are expected to change in the future, like selling price is also changing, variable cost is also changing. So in that case, simulation is more helpful. So simulation is a software that can make adjustments for various variables like selling price, variable cost, fixed costs, residual values, all being changing together. So the correct answer to the question D is B. B for burgers. Okay, students. Let's move on to the next part, the part E, the requirement E. So let's read the question. Is it possible to have a negative real discount rate to apply to the cash flow? Estimates made in current terms when making investment decisions. So yes, it is possible that you get a negative real discount rate. So when do this happens? The real discount rate can be negative when inflation rate is higher than the discount rate, the real discount rate. So in these situations, it can be a negative rate. So we can calculate present values even if the discount rate is negative. It doesn't matter. So if the rate of inflation exceeds the money's cost of capital, we can have a negative rate. So the answer to this is yes. Yes, we can have a negative discount rate. And when do this occur? So it will happen if the rate of inflation exceeds the money's cost of capital. Like the cost of capital is, for example, 10%. The money cost of capital is 10%, and the inflation in the market is 15%. So if the inflation rate exceeds the money rate, then obviously the real rate should be a negative one. And the present value will not decrease in that case. The present values will increase in case of negative discount rates. Okay, so this is the correct answer to this question. So we would say yes, and then it will happen if the rate of inflation exceeds the money cost of capital. Okay, so students, there we go. Our question 1 is completed. Let's move on to the question number 2 now. So students, please read the question 2 first. After you read the question 2, I'm waiting around 2 to 3 minutes for you to read it comfortably, and then I will start with further solving the parts to this question, right? So again, 5 questions, A, B, C, D, and E to this question number 2. So students, please go through the question, then I'll start. Yes, this video will be available after the class. Now we are doing question number 2. Okay, students, there is a question: why for part E wasn't deflation? So in case of deflation, it is not necessary that the discount rate would go down. The discount rate may uh, it may be positive in case of deflation as well, because it depends on the comparison of the money rate and the rate and the cost of capital. Okay, there is a question why we take power 2 in the second year. We take power 2 in the second year because the prices being given are for the year 0. It's for today. So the prices will increase 2 times within 2 years. That's why we have taken 2. Okay. Some questions may require further explanations, which you may ask on the group, right? On the WhatsApp group. So I'll be answering there, right? Because it will need detailed explanation. So obviously we are doing some more practice work in this in these sessions. So we will keep doing more practice right now, and then we may get into more details afterwards on the WhatsApp group, right? So I'll be available there. Whenever I'll be getting time, I'll be explaining you to on the WhatsApp group as well. So you can ask short questions on this. Yes, chat. Yes, you'll be sharing the information regarding the WhatsApp group as well very shortly. Please wait for it. You will be getting it either today or tomorrow. Don't worry. You please keep noting down your questions on your notebooks so that you can ask them afterwards as well. So if you have short questions, very basic ones, you can ask them. But if you need details, so then obviously this is a revision session, so we have to go fast over here. I won't be able to go in very much longer details, right? So thank you for cooperating with me. Okay. Yes, you'll be getting the details for the WhatsApp group. Don't worry. Okay, students, let's move ahead. So in this question 2, care company. The first requirement: what is the equivalent annual cost of the machine 2? So there are 2 steps to be followed in calculating equivalent annual cost. Step 1 is calculate the present value of cash flows associated with the investments, with the replacement, and then step 2 is calculate the equivalent annual cost, right? So this equivalent annual cost, EAC stands for equal annual cost. This is equal to the present value of cash flows calculated in the first step divided by the annuity fraction, right? So first we need to calculate the present value of cash flows. Let me tell you about the present value of cash flows. Which cash flows to pick? So I'll be highlighting the cash flows from the question. So they are asking about machine 2. So let's look at machine 2's data. Now, equivalent annual cost is used in order to check that in how much time you need to replace the equipments and the assets. So whether you should replace in 2 years time, 3 years time, 4 years time, in how many years you need to replace the asset. So in order to check this, you first calculate equivalent annual cost. Equivalent annual cost means like if the cost occurs equally every year, same cost occurs every year, what will be that? So first, in order to check that what will be the equal cost annually for 3 years, the replacement cycle is 3 years over here, right? And the initial cost is 540,000. So 540,000 is already present value. Then the scrap value is 1,20,000. This will occur in 3 years time. And then 47,000 is annual running cost. And this is expected to occur as per question at the end of the relevant year, each year, right? And the discount rate is 10% in the question. So let's first calculate the present value of these three cash flows, right? So the first cash flows is 540 minus 540. So the present value of 540 is itself present value because you will be spending 540,000 immediately. So it's present value itself. Then 47,000 will occur for next 3 years. So using the discount rate of 10%, the annuity fraction is going to be 2.487. So multiply 47 by 2.487. You can also check the present value fraction from the table as well to speed up right now. Otherwise, you can use the formula 1 minus 1 plus r to the power minus n divided by r, which is the formula for the annuity fraction, right? Okay, so we need to calculate present value of 47, the running cost, and then we'll be receiving the residual value in the future. So the residual value is going to be 120,000, and the present value fraction is going to be 1.1 to the power minus 3, which will be 0.751. So look, 540 has been taken as negative because this will be an outflow to purchase the asset. Then 47,000 is the annual running cost each of the 3 years. So 47,000 is also taken as negative. And then in the end, 120,000 has been taken positive because this will be the residual value which will occur by the end of 3 years. So this will be a cash inflow, right? So the present value please calculate on the calculator. With me, the present value in this case is 566.731. So you can see the present value in red, minus 556.731. Now, next step will be calculating the equivalent annual cost. The equal annual cost is the present value divided by the annuity fraction. So the present value is minus 566.73 divided by the annuity fraction, which is 2.487. So please divide this by 2.487 in order to arrive at the present value, the annuity fraction. minus 566.73 divided by the annuity fraction, you will arrive at the equivalent annual cost. Now, equivalent annual cost means that if you incur the same cost every year, and remember it's annuity, which is an equal cash flow at equal intervals of time. So this formula, EAC formula, comes from the formula of annuity. The present value of annuity is equal to the annuity multiplied by the annuity fraction. So what I have done, I have taken A is equal to present value divided by the annuity fraction. So this is what being done over here. So the present value of cash flows is in the numerator and the annuity fraction is in the denominator, and this gives you the EAC. A stands, or the annuity stands for the EAC. So this is the cost. So annual cost will be approximately 228,000. So the correct answer to this question is, to the nearest 1,000, 228,000. So that's the correct answer, which we'll be putting over there in the block. And let me put it over here as well. So 228,000 is the correct answer. Okay, students, let's move ahead. So that's equivalent annual cost. Yeah, actually two of the figures, I'm getting a question from Sidra. So what happens that the equivalent annual cost, obviously it's a cost. So cost will result in a cash outflow, right? So there are two costs which are outflows, and one is a receipt. So residual value is the amount that will be received. So it has been taken positively, and the other two have been taken negatively, right? The running cost is, if it will be an outflow, that's why I have taken it negative, and the purchase cost also I have taken negative because it will be resulting in an outflow, right? So I hope it answers your question, Faizan and Sidra, right? And I've repeated step one, Adil. So I hope you have got the answer to this as well. Okay, over here you won't be requiring to enter in, but in exam you will be able to enter the answer. The box over there will accept the answer. You will be able to write in it. Yes. In the exam they will be telling you whether to give the sign or not, right? So if there is a sign possible over there, they will be telling you to write the sign minus or plus over there, or they may be giving you a minus sign outside the box, right? So don't worry about that. Okay, students, let's move on to the next part of this question. Part B. So in requirement B, they are asking that drag and drop the relevant statements to indicate whether they are true or false. First, the equivalent annual cost calculation assumes the same type of machine is going to be used into the foreseeable future. Yes, this is the correct assumption. If we are going to use the same machine again and again, only then we will be using this equivalent cost method. Like the machine we have right now, or the car we have, suppose right now we are going to replace the same car again and again, only then you will able to calculate this. If suppose if the car is changing, then the cost will also change over the years, right? So the assumption is correct. The second one is The equivalent annual cost calculation assumes the capability of machine 1 and machine 2 are identical. Yes, the capability should be identical. Only then you will be able uh, to do this. Otherwise, it won't be a comparison like versus like, right? So we are just checking the time element, that whether to replace in 2 years time or 3 years time or 4 years time. We are not comparing that which machine is better. We are not comparing the quality of the asset. We are just comparing whether to replace in 2 years, 3 years or 4 years. We are comparing the time. So other things should be equal. So yes, both of the statements are uh, true. Both statements are correct. Okay, students, let's move on to the part C now. So now this question is a joint probability question. So let's solve it. This question belongs to the topic of risk and uncertainty in evaluating an investment. So please read this question first properly. I'm waiting for 2 minutes for you to read it properly and understand it, and then I will be starting to solve it. Students, please concentrate on the phrases being underlined by me and circled by me. These underlined and circled items are important for you to understand the question. And the scrap value which was stated above was 120,000. So they are talking about the calculation of the scrap value. So they are asking about the expected value of the scrap proceeds. So this is a risk situation. In the risk situation, what happens that we don't know exactly that what cash flow will occur in future, but we know the probability that by what are the probabilities for a different cash flow to occur. So the cash flow can be different from 120,000, but they have given the chances. So this is a risk situation. So if you can calculate the probabilities, you are confronting a risk situation. But if you don't know any probabilities and you cannot calculate it, then you are facing an uncertainty situation, right? So this is a risk situation, and we can calculate an expected value. So we will be taking an or calculating an expected value. What is an expected value? It is a product of the cash flow and the probability. And over to calculate a joint probability because they have given chances of a change in supplier and strengthening of dollar as well. So there are two things and two variables, the supplier and the strengthening of dollars, and the probabilities of these have been given. So you have to use the probabilities of both. That's why we'll be using a joint probability. So the cash flow is dependent on joint probabilities over here. So let's see how to do it. So this is a tricky question, so I'm giving some details as well over here in this answer, so you can note down the details as well. So let me start with the details. There are four possibilities in this situation. Please note down the statements I am writing so that you have the basis for the calculation in this situation, and joint probabilities are involved. Now, why four situations? So two possibilities for the change in supplier, yes or no, and two probabilities for the change in the strength of the dollar, yes or no. So 2 into 2 makes 4 possibilities. Let's check the various possibilities. So the first possibility, is the change in supplier. The second one is increase in strength of dollar. And then the sale proceeds okay. The first situation that the supplier remains same, yes. Oh, okay, sorry. The first situation is the supplier changes. So the chances of the changing of supplier is 40%, 0.4. And suppose the dollar also strengthens. So what if the dollar also strengthen along with the supplier change? So both of the things change. So what are the chances of change in the strength of dollars? The chances of changing in strength of dollar is 30%. And if both of the things change, so if this new supplier comes around, the sale proceeds goes down by 10%. And if the dollar strengthens, it further goes down by 10%. So what happens that the sale proceeds are 120,000. And if both of the things change, the supplier and the strength of the dollar, then the sale proceeds received will be 80%, a 10% drop in both. So 120,000 into 80%. This gives you 96,000 cash flows. Right? Now the second situation, suppose that the supplier change, the chances of which is 40%, and there is no change in the strength of the dollar, the chances of which is 70%. So in this case, only one variable change and only 10% of the decline will take place. So in this case, we will be taking 120,000 into 90%, a decline of 10% only. So this will make 108,000. The residual value will be 108,000 in this situation. What's the third situation? Now the third situation is the supplier do not change. No change in the supplier. and the chances of this is 60%, 0.6, but the strength of the dollar changes. So the chances of this is 30%. So in this case also, there will be 10% decline in residual value. But the fourth situation is that neither the supplier changes, the chances of which is 60%, and nor there is a change in the strength of the dollar, the chances of which is 70%. So in this case, the resale or the scrap value remains at 120,000. So now what happens? You have to multiply let me show you the calculation. You have to multiply 96,000 by 30%. The chances of the cash flow to occur at 96,000 is 30%, and then further 40% that even the supplier will also change. So this gives you, if you multiply 96,000 by 0.3 and 0.4, so after applying with the joint probability, you get how much? Multiply it and you get 96,000 into 30% into 40%. So 11,520. Likewise, you multiply other possibilities as well. 108,000 into 0.7 into 0.4. Then okay, 108,000 into 0.7 into 0.4. Likewise, multiply others as well. And then add all of the answers which we have calculated. Now, once you add all of the answers, resale value into the joint probabilities, you get 111,600, which is the correct answer. Okay, students, please note down. Okay, so the correct answer is C. C is the correct answer. This question. So please note down. Okay, now I'm moving to the next part. I'm waiting a few for 2 minutes to allow you to copy it. Okay, there is a question that how does 80 and 90% come? So what the question says that if the supplier changes, the residual value will decrease by 10%, right? And if the dollar also strengthens, then there is a further decrease by 10%, right? So in total, if both of the things change, right, the resale value will drop by 20% and you get 80%, right? And if only one of the items change, then I am taking the residual value as 90% because there is just a 10% drop. So when both of when the probability of both of the things changing, then I've taken 80%. Otherwise, only one thing change, I've taken 90%. Residual is 120,000. Is it okay, Adil? So Janvi Kabra also asked this question. So I hope you get the answer. Okay. So let's move on to the next question now. So the requirement D is to overcome the difficulties of incorporating probabilities. To overcome the difficulties of incorporating probabilities into the investment appraisal questions, care company could perform a simulation exercise to help reach a decision. Drag and drop to indicate whether the following statement relating to simulation are true or false. It eliminates the effects of risk associated with the various estimates. So it's no. But use simulation as a software which just helps you calculate the NPV in a risk situation. Right now, simulation is not a technique which will help you remove the risk from the circumstances, right? So completely incorrect. It won't reduce the risk. The simulation won't reduce the risk. It just helps you in accounting for various risks and adjusting the NPV. Okay, the second one, it requires probabilities of estimates subject to risk to be known. Yes, that's correct. Obviously, you can't over here in the question above, we use the probabilities and we consider only one effect, the effect of the residual value. Simulation is a software which can consider the effect of many variables changing together, and obviously without probabilities you can't calculate any expected values. Simulation helps you calculate the expected values, so it does help in this thing. So the correct answer is 2. First, 2 is correct. So first one was the common sense that it can't remove risk. Okay, the last part, E, which of the following statements about care companies replacement are true? So the decision between machine 1 and machine 2 could be found by calculating total NPV of each machine over a period of 12 years. Yes, it can be. See what they said. They said that machine A can be replaced in machine 1 can be replaced in 4 years time, and machine 2 can be replaced in 3 years time. So if you multiply both these items, you get an LCM of 12, right? So in 12 years time, this machine will be replaced 3 times and this machine will be replaced 4 times. But the condition of the machine by the end of all replacements will be equal after 12 years time. So you will be comparing the 12-year cash flow of machine 1 with the 12-year cash flow of machine 2. So instead of EAC, you can also use this LCM method and calculate NPVs for 12 years for both of the machine A and machine 2 replacement in 3 years and 4 years time respectively. So that's correct. You can also use an NPV using the LCM to calculate the years for which you will be calculating the NPV instead of using an equivalent cost method. So both of the methods are correct. Equivalent cost method and LCM rule, both are correct. So this one is correct. Then the second one is the replacement analysis model assumes that care company replaces like with like each time it needs to replace an existing asset. That's correct. That's the same thing which we're discussing in the first part. 12 years time have been considered to check the replacement of machine 1 and 2 both. So same time to compare like versus like. So both of the statements are correct. The correct answer is B. To this question. So okay, students, that's question 2 is done. So moving on to the question number 3. Now this question is starting with the rationing project question, capital rationing proposals. So students, please go through the question. It's a short question, but too many requirements, 5 requirements over the short question. Let's do it. So I'm giving you 2 minutes to please go through the question, read the question. Okay, students, let's start doing this question. Let me first show you the block which I have made. This shows that the total investment uh, is 30.62. This much of cash is required immediately so that you can invest in all of the projects from A to E. As the NPV of all the projects is positive, you can invest in all of them, but unfortunately the funds available which are shown is just 10 million. So obviously you won't be able to invest in all 5 of the projects. You have to select some of them. But according to the financial objectives of the company, you have to maximize the wealth of the company. So you have to select the best amongst these so that you can use your 10 million to generate the maximum NPV which can be generated out of these 5 projects. So you can't take a substandard decision and select a project which gives you a lesser NPV than when in case that you have a better project available. So let's select the best of this. So let's first do requirement A. Now this is a capital rationing situation. Capital rationing situation occurs when you have too many projects with positive NPV and you want to invest in it, in all of them, but unfortunately you don't have that much of cash. So there are 2 situations due to which you don't have cash. One of the situation is external factors. Like external factors means that the creditors are not ready to give you money. The creditors are not lending you money, or the equity investors are not investing in the business, so obviously you won't be having cash. So there are external factors which are binding you and restricting you to invest. And if there is an internal factor, like the management themselves don't want to invest further, and they want to do limited investments and to remain in lesser projects and give quality, or they don't want to do too much work and spoil the quality. So if they are, or they don't want to issue shares and lose their control over the company, as some new people will become the shareholders. So in that case, if management is trying not to raise further funds themselves, then there is an internal problem. There is an internal restriction. So that's known as a soft rationing. And if there is an external issue, that the creditors or the fund providers, the equity investors are not giving you funds, then there is an external problem known as hard rationing. So the requirement is on soft and hard rationing. Let's go through the question first. Indicate by clicking in the relevant boxes whether the following statements about the capital rationing are true or false. So what's the first statement? The first statement is both hard and soft rationing are the result of external factors. False. Both hard and soft rationing are a result of internal factors. False. Then hard rationing is the result of external factors, and soft rationing is the result of internal policies. That's truth. And soft rationing is the result of external factors. Hard rationing is the result of internal policies. That's not truth. That's false. So that's our answer. So only the third one is truth. Okay, students. Now let's move on to the next part of this question, part B. From the list below, part B. From the list below, select which two projects should be accepted based on the circumstances described. So in order to do this, let's make a small working. I'm making a small working to show you something. The first is net present value. See, the project is generating an NPV of 4,900 and the investment required is 3,200. So if you divide 4,900 by the investment, you are earning 1.53 per dollar of investment, right? So each dollar you invest project, you will be generating 1.53, and this is known as profitability index. This is known as profitability index. Like you calculate contribution per hour, contribution per limiting factor. In the same manner, we are calculating NPV per dollar. So project A is generating 1.53 of NPV per dollar. Product B, the NPV 7,400 and the investment is 9,320. So if you divide NPV with the investment, you will get the NPV generated per dollar of investment, which is 0.79. So project A is much better than project B, because project A is just generating 0.79 NPV over $1. So now project C, it generates 5,900 NPV over 7,300 of investment. So it is giving $0.8 per dollar invested. Again, this is also lower than A, but better than B. Okay, then the fourth project, the project D, the NPV generated is 7,500 and the investment is 5,200. So 1.44. This is also a good one. After A, this is the next highly generating NPV project, and then in the project E, the NPV be generated is 9,000 divided by the 5,600 of the initial investment. So it is 1.6. So the best out of these is E. Then the next best is A. And then the third one is D. Then the fourth one is C, and then the last is B, which is generating the lowest NPV per dollar. So project E is the best one, which is in red, and project A is the second one. Okay, so now let's check. If you look at investments, if you invest in project E, you only require 5,600, right? You do have short funds, so you require 5,600, but you have 10 million. So you can take the second ranked project A as well together. So if you invest in both A and E, so in total you will be investing how much? The first rank project and the second one, you invest in both. The investment amount will be 88.8 million, whereas the NPV generated will be the sum of the two, and that's going to be 4,900 plus 9,000, which makes 13,900. Now you can't earn more than this in any case. If you make another combination, you can make one more combination of project from which you can generate further NPV, and that is project A and D. If you take project A and D, you will be investing how much? 8.4 million and generating an NPV of 7,500 plus 4,900, which makes 12,400, which is lower than this 13,900. So what's your objective? You want to earn the highest possible NPV. Highest possible NPV is required, which is 13,900. So if you make a combination of these two projects, the project A, which is highlighted in yellow, and the project E, so you get the highest NPV as they are the highest ranked projects. Now see what they say, that these projects are indivisible. What do we mean by indivisible? Indivisible means we can buy only one of them, and we have to buy the full of these projects. We can't buy part of these projects. So part investments are not possible. So like I'm having some more money as surplus out of 10 million, 1,200 I'm having surplus, but I can't invest because the projects are indivisible. Indivisible means, okay, they cannot be divided and cannot be invested in part. I have to purchase the full of them. So I have to stop at 8800, and at 8800 I'm generating the highest NPV. So I'll be stopping at there. So what's the best combination which I can take is project A and project E. The correct answer is A and E, which gives me the highest possible net present value due to the projects being indivisible. And divisible projects means we can buy parts as well. So I could have invested the remaining 1200 as well in project which is next ranked, which is 3. I could have invested some amount 1200 into D if the project would have been divisible. But over here it is not divisible. The projects are not divisible, so I can't invest any further. I have to stop at 8800. I'll be left with some surplus funds as well. So what's the correct answer over here is A and E. Okay, students, now moving on to the C. Yes, this is trial and error method which I have used. Mohammed Tayyab, this is a trial and error method which I have used. Yes. Next question is from Osama Ishfaq, that what is mutually exclusive? Mutually exclusive means okay, you have to exclude any one of those two. You can't invest in both together. So if you can't invest in both together, then the projects are said to be mutually exclusive. Okay. Okay, students, let's move on to part C. Now in part C, they say that what projects would be accepted if projects A and E were mutually exclusive. Mutually exclusive means I can't invest in A and E together. So this option becomes wrong because I cannot invest in A and E. Now, right? Now, if I invest first in E, right? If I invest first in E, how much funds will be required? 5600. So I cannot purchase any other project with E if A is mutually exclusive, because A requires how much? 3200, and I cannot invest in A because it is mutually exclusive, and other all projects are 9000, 7300, or 5200. So some with any of these would require more than 10 million, so I cannot make a combination of it, right? But if I leave E, suppose if I leave E, right, and I use make a combination of A and D, means the secondly ranked and the third ranked project, is it possible or not? It is possible because this will involve 8400, both of these, and I can generate an NPV of 12,400 from this. So this can be a better one in case that A and E are mutually exclusive. So as I cannot invest in both of these, I have to leave any one of them. So if I leave E and make a combination of the second and the third, then I can earn how much? 12,400, which will be the best. And any other investment project won't allow me to invest in two projects, as I have only 10 million, and making a combination of two is not possible other than A plus E and other than A plus D. Only two combinations are possible of two projects, A plus E and A plus D. Others in case of others, there are very heavy investments, so we can't make a combination, and without making a combination, obviously the NPV will be lower than a combination of two. So in this case, which is the best? So in this case, what happens that you invest in A and then in D. If you invest in A, you generate an NPV of 4,900, and in case of D, you generate an NPV of 7,500. The sum of both these NPVs will be 12,400, and the investment amount is 3,200 and 5,200, which makes 8,400. So that's practical. So this is the highest possible NPV. So A, and the correct answer is A, combination of A and D. So A is the correct answer. Okay, students, let's move ahead. Now, what the next part asks. Now, in this case, the part requirement D, what the question says that the projects are indefinitely divisible and ignore the mutually exclusive limitation. Means there is no mutually exclusive limitation. You can invest in A, E, any projects together. You can mix any of the projects. There is no mutual exclusive limitation in this question. Divisible means you can buy a part of the project as well. It's not necessary that you buy the full project. You can invest in part. So in this case, if the project is divisible, you will use the ranking. You will strictly follow the ranking. No need to make combinations and all. Just start following the ranking, and as we will be following the ranking, so you will be definitely investing in the highest NPV generating projects. So first of all, you will start with. So remember one thing, that if the projects are divisible, you will be following the ranking. You won't be going for making combinations and using the trial and error method, right? So first of all, you will go for the best, which is E. And E requires how much? E requires 5,600. And the NPV generated will be 9,000. Then comes the second one. So the rank of the second one is A second, project A. So project A would make you earn 4,900, and investment required is 3,200. So in this case, the total investment made is 3,200, but you are left away with further money, which is 1,200. So you can further invest 1,200, and the project is divisible. All of the projects are divisible, so you can purchase part as well. So over here you are left away with 1,200. So you can invest in the next rank. What's next? The third one is the project D. So you'll be investing in project D. So by investing in project D, you can not invest all of it. You will be investing 1,200 out of the total investment which is required in project D, which is 5,200. So 1,200 divided by 5,200. This makes how much? This makes 23.07%, or 3 upon 13, you can say. alphabet B. Alphabet B is the correct answer, and we will invest in A, full of A plus full of E, and plus 3 divided by 13 is 23% of D. This is the correct answer. Okay, so remember now that when the projects are indivisible, you have to make different combinations so that all of your funds or majority of your funds are invested, and you will find a combination with the best NPV. That will be the best selection for you. And in case of the projects when they are divisible, just go on following the ranks. Select the project with the first rank, then second, third, and keep going on, and in the end the remaining funds will be invested in the project. Even if it is 20% or 25%, you can go with it. So your last remaining fund can also be invested, as you can invest a part in a part of the project as well. So like in this question, we invested 23% in project D. Okay, so let's move on to the next E, part E. Okay, it was written, Aisha, it was written about that the project is divisible or indivisible. For the first part, the projects were indivisible. That's why I was following indivisible assumption, and then afterward they said that the project is divisible. Then I moved on to the indivisible. Okay. Thank you, Rohit. Okay, so let's move on to the next one, the part D, part E, sorry. Let's do the part E. First, please, this is a longer question, so please go through it. First, read it out, then I'll be telling the answer to this question. See, the correct answer is A and E. Now, why A and E are correct? Let me tell you. In the first, just let me tell you the arguments in short. That in first part, it says it has a negative NPV when undiscounted. What do we mean by undiscounted? Undiscounted means if you calculate the present value when the rate is 0%. Suppose the cost of capital is 0%. What happens? This is negative. This is the minus investment, and the spend is also in minus, and this is positive. So if you do not discount it, right, so the present values will be the same. The same amounts will become the present value because if there's a 0% rate. So obviously the NPV is negative over here. Just deduct the bracket ones from 8.8 million. So the bracket amounts are 8.83, and without bracket 8.8 is positive. So there is an NPV of 0.03 negative. That's correct. That's correct. Undiscounted 0% rate, the NPV is negative. Then it never earns a positive NPV. No, that's not correct. It will earn a positive NPV if the rate is suppose 6% or 8% likewise, right? So when you calculate present values of these, the present values will go down. Suppose you take 5%, 6%, the present values will go down. So the IRR of the project is there is an IRR of the project, and the cost of capital, if the IRR is greater than the cost of capital, the project will be acceptable. So it has no real IRRs. That's also not correct. It does have real IRR. If you calculate an IRR, you will get it. So just calculate one IRR and see what does the IRR is. So there are two IRRs possible in this case. One is 5% and the other one is 15%. So there can be two possible IRRs in this case if you calculate, right? I'm not calculating it, just telling you that there are two possible IRRs, which is 5% and 15%. So there are real IRRs, but there are two IRRs possible in this case. Why? There are two IRRs possible because whenever, suppose after year 0, there is a negative cash flow. What happens over here, that in year 2 there is a negative cash flow. Whenever there is a negative cash flow after year 0, there will be multiple IRR situation, more than one IRR situation. So this is also correct. So as there is a negative cash flow occurring after year 1, which is in year 2, if you are having a positive cash flow in all years after year 0, there will only be one IRR. But if there is more than one negative cash flow, means even in year 0 there is a negative cash flow and afterwards also there is a negative cash flow, then you will be getting more than one IRRs. Okay, it has one positive and one negative IRR. No, that's not the case. Both IRR will be positive because rate cannot you won't be able to calculate a negative rate. So that's also not correct. So these two are the correct ones. So you have to remember two things over here, that if simply the cash flows, if added, give you a negative number, then at 0%, if we do not discount it, NPV will be 0. A is correct. And if we have a negative cash flow after year 0, then we get more than one IRRs, internal rate of return. And in that case, your cost of capital should be somewhere between 15% and 5%, because rates between 5 and 15% will give you positive NPVs. And rate afterwards will not be acceptable more than 15%, and less than 15% will also be not acceptable, because both sides there will be negative NPVs. At less than 5% also there will be negative NPVs, and at more than 15% also there will be negative NPVs. This is just for your understanding I'm giving like this, but you don't need to calculate the IRRs over here. Just you need to calculate one of them so that you can know that there is a real IRR present. So just find an IRR for this question. You will find one of them, either 5% or 15% one. And remember this thing, that if there is a more than one negative cash flow, you will be having two IRRs. So the correct answer to this question is A and E. Okay, students. So let's move ahead to the next question. This was question number 3. Now we come on to question number 4. Yeah, the cash flows which usually have a negative cash flow in year 0, and afterwards if all cash flows are positive, they are known as conventional cash flows. But if we get a negative cash flow after year 0, then we tell it a non-conventional cash flow. So in that case, we have to take a cost of capital between the two IRRs. Saifullah, this needs to be discussed in detail. It will take a longer time, so we can't discuss right now. You can ask in the WhatsApp group when you get the number, right? So I will explain it over there. So Omar, I have answered your question. Yeah, if you use a Ibrahim, you use a spreadsheet formula, you can calculate two IRRs, but it's not required right now as you are not having the IRR formula in the exam. So I'm not calculating right now, but you can. The spreadsheet will tell you two IRRs. Okay, so moving on to the question number 4. So students, I'm going a bit faster over here right now. So let's start doing question number 4. ACE company. In the ACE company, let me calculate the NPV, the requirement A. First, I have to calculate the present values. So according to the question, they are investing in loose tools and they will be generating a contribution. And they will be paying tax as well on the contribution. So loose tools will be purchased when time is 0. Contribution will be received since year 1 till year 4. So there is an annuity in this case. So you can use the annuity fraction over here to calculate the present value. So the loose tool amount is 6,000. The investment is 6,000. CF stands for cash flow. So minus 6,000 is the loose tool amount, and the contribution is going to be 25,000 per annum for the next 4 years. And tax is payable in arrears. So tax will start from year 2. The year 1 tax will be payable in the year 2 after 1 year's time. It's in arrears. So you will be paying taxes from year 2 till year 5. Even after the completion of the project, you will be paying the tax. Okay, and the tax amount is going to be 25,000 multiplied by 25% is the tax rate. So the tax amount is going to be 6250, which will be minus because the tax payment will result in a net cash outflow, right? So now the multiplying with the fractions, present value fractions. So present value fractions for the cash flow in year 0 is 1, and the annuity fraction is 3.037 at 12%. Right, you can find it out from the table, or you can use the formula as well for the annuity. And the annuity fraction from year 2 to 5, how will you get it? So first you'll have to take an annuity fraction at year 5, right? And then you will deduct the annuity fraction for year 1, because you don't want the present value for the year 1. So by doing this, the annuity fraction is going to be 3.604. I've taken the formula 3.605 for 5 years, and for year 1 the fraction is going to be 0.892. So if you deduct the year one's present value fraction from the 5 years NUT, right, you will reach the NUT fraction for the years 2, 3, 4, and 5. Right, so this is going to be 2.712. The NUT fraction is going to be 2.712. So what I did, I needed present value from year 2 till year 5. So first of all, I calculated the present value fraction for 5 years and then deducted the unwanted year one's present value fraction. So I got 2.712. So this gives me the present values. So present value for the loose tools, contribution, and the tax. And this gives you the net present value. NPV So the NPV is 52,975, a very high NPV. So you have to give the NPV in the nearest 100. So the next nearest 100 is 52,300. So 52,300 will be the nearest one. So that's the answer. 53,000. 53,000 will be the nearest 100. So that's the correct answer, and the correct answer is option B. Okay, students, I hope you have completed this question. This was a simple one. Okay, so let me tell you the answers to the remaining parts. I'll be going a bit faster now. So let's do the part B. I'm giving a minute to copy this requirement A's answer, and then moving on to part B. Okay, students, part B. So the part B says that the IRR of the project above has been correctly calculated as 26%. Which of the following statements are true? The IRR is not a measure of absolute profitability. That's correct. That IRR is not a measure of absolute profitability. The IRR will not give you an NPV in dollars. It gives you percentage. It's a relative measure. It's a percentage. So it's not an absolute figure in dollars. And linear interpolation provides only an estimate of IRR. That's also correct. That linear interpolation, what we are using a formula of a line. That the formula for IRR is a formula for a straight line. So we are using an linear interpolation in calculating the internal rate of return. So that's correct. The first one is correct. And the second one is, it says that if the IRR of the project is higher than its cost of capital, then the project is always acceptable regardless of the pattern of the cash flow. So that's not correct. See, the IRR of the project should always be higher than the cost of capital. But if the pattern of cash flows is the same as that which was given earlier. There were negative cash flows arising after year 0. So if there is a negative cash flow arising after 0, then as I said, there were two IRRs. Like, for example, 5% was one of the IRR and the other one was 15%. So only percentages between these two, the 5% and the 15%, were giving positive NPVs. And if there is a negative cash flow other than the year 01, then you are having a negative NPV after 15% and a negative NPV after and before 5% as well. So you can't say that in all cases the cost of capital, if lower than the IRR, will give you a positive NPV, because if the cost of capital over here is 4%, then NPV will be negative in this case. And this is due to what? This is due to a non-conventional cash flow. So if there is a non-conventional cash flow, in that case, you won't be getting this rule correct, that IRR of the project should be higher. Even if the IRR of the project is sometimes cost of capital is higher, sorry, if this rule is not followed, even then you can get so non-conventional, in case of non-conventional cash flow, this rule will not be observed. Right? So this one is not correct. So the correct answer to this is only the first statement is okay. So the correct answer to this is C. Alphabet C, Charlie, is the correct one. Okay, and the next part is C. Okay, overheads are fixed cost. In this question, that's allocated overheads are not incremental cash flows. That's why I have not used it, Mohammad Rafe. In order, if the allocated overheads means it is part of the existing overheads. In NPV, we need incremental cash flows, right? Okay, and Ibrahim, he's talking about the pattern. Pattern means that either the cash flows will always be positive after the initial, or they may be sometimes positive and sometimes negative. If they are sometimes positive and sometimes negative, then there will be two IRRs, and the projects between those two IRRs will be acceptable, right? And the projects, the cost of capital of which is between two IRRs will be acceptable. So it's not necessary that IRR should be always higher in that case, right? So Salina, I've answered your question as well. Is it okay? So you have, the cash flows are important when there are two IRRs and there is a non. Yes, the IRR will fail in when the pattern changes. Yes, that rule will fail. So that's not correct, na? What do this says? This says that that always the higher IRR rule will be applicable. So it's not always. It's not irrespective of the pattern. Pattern is also important in case of decision making with more than one IRR. Okay. We don't take fixed overheads. We will only take incremental overheads. Over here, they are given allocated overheads. Allocated overheads means divided overhead out of the existing overheads. So according to the question, no additional overheads are taking place. The word allocate means no incremental. It should be, the word should be incremental overheads. Additional overheads should be there for we to deduct it, right? Okay, clear, Adil? Okay, let's move on to the part C. The part C says, if loose tools become allowable for tax allowable depreciation, which of the following statements would be true? So they say that the tax people are allowing for depreciation. So if you deduct tax depreciation from the taxable income, your taxable income will fall and you will be saving some taxes. And if you save some tax, your NPV will increase. If you save some tax payments, your NPV will increase. So according to the question, the NPV of the project would rise. This is perfect. NPV would rise. Okay, the first one, it says reported profit before tax would rise. No, reported profit would not rise. Reported profit means financial accounting profit. Financial accounting, the profit being shown in financial accounting is reported profit. So in reporting profit, tax depreciation is not deducted. In reported profit, the accounting depreciation is deducted. So even if we get a tax depreciation, it doesn't matter because it's not deducted from the accounting profit before tax. So this is not correct. And then 3, assuming that one of the answers to the NPV calculation above is correct, that the decision to proceed would alter. So what do you say? That the one of the options, suppose this part 2 is correct, so will your answer change? No, your answer won't change because your NPV was positive. So in case of the 53,000 NPV, you are going to select the project. So even if it increase further, it will remain, yes, acceptable. So the answer is not changing. So this is also not correct. So the correct answer is 2 only. The answer to this is alphabet C, Charlie. So C is the correct answer to this. Now moving on to the next part D. The part D says one of the directors thinks that calculating the payback period would be useful addition. What is the project's payback period? So what is the project's payback period? So 6,000 was the initial investment. How much time will be the initial investment paid back? You are getting 25,000 in year 1. The contribution is 25,000, right? And in the year 1 there is no tax. No tax in year 1. Tax starts from year 2. So within first year, the project is paid back in just a few months. How many months? 6,000 divided by 25,000 gives you the number of months. You need 6,000 to pay back, right? So just in 0.24 multiplied by 12, the project is paid back. You get the 6,000 amount returned back. This is at 2.88. So in 2.88 to 1 decimal place, we will take 2.9 months. The correct answer is in one place 2.9 months. They are asking in one place, so round it off. So it will make 2.9 months. So correct answer is 2.9. So in just 3 months, the project pays back. Okay. Now, what about part E? No, decision won't, Duresh, our decision will not change because already the NPV was positive, right? And if we get a tax depreciation, our taxes are going to go down. Due to the decline in tax payment, our NPV will increase further. So the decision still remains yes. Earlier also was yes, so it won't change. That's why I've taken it, right? Okay, Duresh. But NPV was not negative in this case. In this case, if the NPV would have been negative, in that case it would have changed. But this is in context of this question only. This requirement is in context of the same this question in part A. In context of part A, they are talking about. Okay. Okay. Then next is part E. Let's move on to part E. Indicate by clicking in the relevant boxes whether the following statements on the payback period are true or false. So the first one, it normally ignores time value of money. So does payback period ignores time value of money? That's correct. It do not involves time value of money. Present values are not calculated. So that's true. Then uh, it is a risk focused approach in decision making. So it is yes. It is a risk focused approach. If the payback is very short, then the project is less risky, because if you receive the money in a very short time interval back, your investment amount back in very short time interval, right, you are not exposed to risk. The projects which take a longer time to pay back are risky. Why? Because the longer it takes, it becomes uncertain. So long, it is difficult to predict longer periods. It is very easy to predict short term. The conditions right now present will not change in 3 months time, but in 6 months time and 1 year time and 5 years time, the chances of changing conditions is very much high. So it makes a project riskier with a bigger payback. Shorter payback projects are less riskier. So that is a risk based approach. Okay, there is a clear advice once it is calculated. No, it's not a clear advice. We need to see the profits as well. In this case only we are checking the risk. Obviously if the risk of the project is low, but afterwards, after 3 months or the short payback period, if the cash flows get negative, what then? And it's the NPV of the project is negative, so you can't select a project with only a shorter payback with a negative NPV. No, you need to at least find the profits as well, and see what happens after the payback period, whether the project is giving a project positive NPV or not. So this is false. So let's move ahead to the next question now. So what do they say? The first one is true. Let's write the answer: true, true, and false. So remember, payback period is not enough. We need to check other things as well. Okay, the next question is Pelta Company. Please start reading this question. Pelta Company. Now I'll be doing a bit faster in this question because I've already trained you regarding the inflation and all. So I'll be working a bit faster. So you can check the calculations afterwards. You can keep a calculator in hand so that whatever I say, you can multiply it and divide or add or subtract so that we can do it faster. So I'm making a schedule for the NPV to calculate this question's NPV. The first requirement is calculate the net present value of the planned investment project. And the second one is calculate the discounted payback period of the planned investment project. And then discuss the financial acceptability. So first of all, I am calculating the net present value of the project. I'm making a short working over here. I will tell to calculate some figures in this question. So please be ready to calculate those figures. Let me first make the presentation. Okay, let me start, students. The sales volume as per question is 5,20,000 in year 1, and in year 2 it is 6,24,000. Year 3 it is 717,000. Year 4 it is 7,88,000. Right now, the sales price is 30. Now you need to multiply the sales price with the inflation. Inflation is 4%. So multiply 30 by 1.04. So you'll get 31.2. Right? In the second year, multiply 31.2 by 1.04. Then in year 3, multiply 32.45 into 1.04. In the next year, year 4, again multiply 33.78 by 1.04, which is the inflation in selling price. Okay, there we go. We get the selling prices up to 2 decimal places. And then let's move on to the variable cost. What they say about the variable cost, that variable cost is 10. Please note that the variable cost is changing. These are all in the present day prices. Present day prices means the decision making date. These are the prices on the decision making date. Current terms means decision making date. We have to inflate all of these. So in order to inflate this price, you have to multiply 10 by 3%, 1.03. Multiply 10 by 1.03. So 10 multiplied by 1.03 gives you 10.3, the inflated variable cost. Now for calculating NPV, you need to calculate money cash flows. These are known as money cash flows. The cash flows being prepared at the inflated selling prices and variable cost and fixed cost are known as inflated or money cash flows. Okay, so the variable cost in the year 2. So 10.2 is at the year 0. So you have to multiply it 1.023 to the power 2. Take power 2 because 2 times in year 1 first the variable cost will increase by 3%, and again in year 2 it will increase. So it will keep increasing on compound basis in year 1, 2, 3, like that. Now in 10.61 is in the present day prices. 10.61 should be multiplied by how many times? 10.61 into 1.03 to the power 3. And then in the year 4, year 4 the price variable cost is 10.93, multiply it by 1.03 to the power 4. This gives you 12.3. Okay, so now let's multiply the sales price with the sales volume. Multiply the sales price with the sales volume and the variable cost also with the sales volume for all years. So students, you all please check my figures which I am calculating. I am multiplying the sales quantity 5,20,000 multiplied by the sales price, which is inflated 10.3. So likewise for all the 4 years the sales will be as follows, right? And then the variable cost. The variable cost is inflated cost. Sorry, the sales price was 31.2. 31.2 multiplied by 520,000. I calculated 5,356,000. Then the variable cost is 5,20,000 multiplied by 10.3, the inflated variable cost. So in all of the years, so there you go, you'll get the variable cost, and then you get the contribution by deducting variable cost from the sales amount. Deduct variable cost from sales amount, you get the contribution. And then the fixed cost. Now the fixed cost, they say, as per question, they have told you in the question that the fixed cost is already monetary in the money terms. It is already in money terms, so I won't inflate those fixed cost amounts. See what they say. They say that the fixed cost are already in nominal terms. Nominal terms means they are already inflated. They are money cash flow, so I won't increase the fixed cost. I will take it as it is. No need to inflate it. Okay, So now we get contribution minus fixed cost. You get the cash flow before tax, before calculating the tax payments. So let's calculate the tax payments now. First of all, calculate the net cash flow. The contribution minus fixed cost. So there we go. We deduct the fixed cost as well. Over here, the fixed cost is incremental. So I have deducted it, right? So now we'll get the cash flows. After taking the fixed cost, you get these cash flows. Now we calculate tax. Tax are payable 1 year in arrears, right? So you will calculate the tax now, and the tax rate is 30%. Check what they say. The cash, see, the cash flow amount is very important. That when does the cash flow takes place? 30% is the tax. It's not enough that you calculate the cash flow correctly. It is important that you place it in the right time. So 1 year in arrears, the cash is payable 1 year in arrears. So we'll calculate the tax at 30%, but we'll be paying 1 year after the year in which the profit arose, right? So what happens? 10,168 into 0.3. This is the tax amount. So tax will be paid till year 5. Okay, please check the figures till now. I'll be silent for 1 or 2 minutes so that you can check the figures till now. Then okay, students, I'm back. Now tax saving on capital allowance. So the tax saving on capital allowance means you'll be calculating tax depreciation, right? And according to the question, it is on reducing balance basis, right? So please follow me what I say. Look, first calculate the investment amount is, what is the investment amount? First check this out, that how much is the investment in this project. It is 25,000, right? So 25 million is the investment amount. So take 25 million, take 25,000, right? And the first depreciation will be 25% of it after deducting the residual value, right? So over here, it's a diminishing balance method, so you won't be deducting the residual value. Residual value is deducted in straight line method. So 25 million into 0.25 multiplied by 0.25. This is the tax depreciation, and due to deducting tax depreciation, your taxable income will decline and you will be saving tax. So you will be saving some tax. So this will be taking as positive over here. You will be saving some cash. So first you will take 25% or 25 million and then multiply it by 30%. So multiply it by 0.3. So you get 18,75,000. Right now, what happens that 18,75,000 the figure, multiply that by 0.75. Multiply it by 0.75. Okay, you get 1406,250. Why did I multiply it by 0.75? Because every year, due to depreciation, the book value will decrease by 25%. Means it will become 75%. So I've directly taken it as 75%. Again, in the next year, take 75% of 1406,250. So this makes 1054,688, right? And in the last year, what happens? The book value. Take the book value. Check it like this. Take the book value, tax WDV. I'm writing down the tax WDV. It's like this: 25,000 multiplied by 75% after deducting first year depreciation. Then again, after deducting 25% will become 75%. In the third year, again, I will charge 25% depreciation. It will become 75%. So what happens? 25 million into 0.75 into 0.75 into 0.75. Do this, multiply 25 million by 3 times by 75%, you will get 10,546,875. Now afterwards, when the webinar gets over, you do this working in detail, you will get the same figures, right? Now this is the tax WDV. Now you get the sale proceeds. According to the question, the sale proceeds are 5% of the assets cost. So take 5% of asset cost. So 5% of the assets cost is this much, 1.25 million. So deducting this gives you loss. Now there is a loss because the assets book value is 10 million 546,000, right? But you get just 12,50,000. You get a loss of 929,675. So on this, you will be saving some money. Loss will be deductible from the taxable income. In the fourth year, you won't be saving any tax capital allowance, because in the year of disposal you don't get any tax depreciation, and the last year you get a loss allowance. So loss allowance is 929,675 multiplied by 30%. So this makes 27,89062. Okay, let me repeat. For 3 years, you kept getting tax depreciation, and due to the tax depreciation, your taxable income declined. Ultimately, you saved tax in the first 3 years, right? So the first 3 years, you saved this much of tax, which is shaded in yellow, right? And then in the fourth year, you won't get tax depreciation. So you get a tax saving of 278,90062.5 on the loss incurred, because you got just 12,50,000, which is 5% of 25 million, being the residual value of the asset, instead of the 9 million book value, 9.29 million book value. So you incurred a loss and you get a tax saving. So now, what is the cash flow after the tax saving? So that's the cash flow after the tax savings for the 5 years time. and then we will take the discount fraction at 12%, which is 0.83893. Now discount fraction is being taken at 12%, right? The tax, remember, always you will take an after tax rate. Always take an after tax rate. Take the discount fraction. Discount fraction is usually taken at 3 places. (1.12 to the power -1, -2, -3). Okay, there you go. You get the present value now. Of all the 4 years cash flow. Now see, this is a conventional cash flow. Conventional means all cash flows are positive, no negative cash flows. Over here you will get only one IRR, but in year 5C what happens? You get a negative cash flow. So the chance for till year 4 there's a conventional cash flow, then it gets non-conventional. So you will get 2 IRRs. You may get 2 IRRs in this question. Okay, so let's calculate the NPV now. So present value of cash flows above. So adding all those 5 items and deducting the initial investment from it. So initial investment amount is 25 million. Okay, and one more item is left, and that's the residual value. I have to take the residual value. So I'm taking it in there. The residual value is 1250. You can also take figures in thousands. Remember some points over here. Let me give you some tips. When calculating present value, always consider the items that involve a cash flow. You have to take a cash receipt or cash payment. And secondly, always also remember that you have to take the cash flows and place them in the right place. If you place it in the wrong year, the present value you'll be getting will be incorrect. So it's very important that you place the cash flow in the right year, right? Because if you place it in the wrong year, the present value will go wrong. Okay, in all years present value fraction is changing. Okay, so that's the present values. And you get the net present value of the project, which is for the detailed calculation on net present value. There you get 10,486,988. So that's the NPV, and as the NPV of the project is positive, you will be accepting the proposal. So students, I hope you have understood the calculation, the detailed calculation of NPV. So this is the easier part of our syllabus. We all must be knowing at least these calculations in our syllabus. Okay, let's no, residual value will not be reflected in tax saving, Natalia, as the residual values are not taxable. We have calculated the loss on the basis of residual value. Like we deducted the residual value from the book value and we got a loss. So on that loss, we save tax, because loss will be deductible from taxable income. We save tax over there. Okay. Yeah, we calculate present value for non-conventional cash flows as well. Obviously, we can get an NPV, but it's in IRR it gets technical. It results in two IRRs. Okay. So students, let's move on to the discounted cash flow now. Now for the discounted cash flow, we will consider discounted cash flow means we have to use the present values to calculate the payback period. Discounted cash flow payback. So the next requirement is discounted payback period. So for discounted payback period, we will use the present values. So you can see the present values over here in yellow color, the row in the yellow, and the requirement is calculate the discounted payback of the planned investment project. So let me calculate the discounted payback. So now comes the working on discounted payback. So I will be taking year, a column for the year, and then annual cash flow. And I'll also be taking a column for cumulative cash flow. Right? So what happens that in year 0, the company made an investment of 25 million. And then in year 1, it came to receive how much? In present value terms, 9080. So in year 1, it received 9080, and due to this, out of the initial investment, which was minus 25 million, it recovered how much? 9 million. So now 15 million are still left back. They are yet to be paid back. In the next year, the company manages to receive 9.233034. So after receiving this, they recovered a further amount of cash due to the year 2 cash flows, and then in year 3, they received a further 9030 from the yellow column. Now in this year, the cash flow gets positive, means by the end of year 2, the payback did not occur, but at the end of year 3, the payback occurred. So after 2 years, it didn't pay back, right? But in the third year, it paid back. So how many months? So 6686942 was received. 6686942 was required to pay back in the third year, right? And how much was received? 90,30,828 was received. So the fraction is how much? 6 million was required and total amount received was 9,030,828. Multiply this fraction by the 12 months time. So we'll get the months. So 0.74 multiplied by 12 months. So around, if we take in a whole month, this becomes 9 months. So 2 years and 9 months, the project paybacks. But this payback is a discounted payback. Time value has been considered, right? Okay, students, let's move ahead. I'm skipping a theoretical part in this question, which I will discuss tomorrow with you people. I'm moving on to the part question number 6 now, Basel. So let's students, please go through the question Basel. I'm moving on to Basel. I'll be giving you an assignment to solve this for tomorrow class. The reason being that we have already considered the divisible and the indivisible projects, so we can do it faster. So please read this question. I will try to do a major part of it right now. The important thing to note is just note that what are the names of the projects. The project one is an investment in workstation. So can you get a part of it? You have to get full. So these are all projects which cannot be divided. We cannot invest in part. They are all indivisible. Project 2 is also workstations, and project 3 is ticket machines. So we can't get part of these projects. So these are all indivisible projects. So we have to use the trial and error method in this case. So please read out. What is the requirement A? Determine the best way for Basel Incorporation to invest the available funds and calculate the resultant NPV on the assumption that each of the 3 projects is divisible and on the assumption that none of the projects are divisible. So you have to do it in both ways. You have to take it one time, you have to take it a divisible, and the other time you have to take it as an indivisible. The projects are not divisible. So but exactly if we see, the projects are not divisible because they are equipments. You can't purchase in parts. But on the basis of assumption, we'll be calculating as divisible and indivisible. So let's check what happens. First of all, I'll be calculating the NPVs, the net present values. So let's do it first, and then we'll be finding out the best solution, the profit maximizing solution. So students, I'm giving you a 2 minutes time to read the question, then I'll be starting it. Yes, Ibrahim, probabilities will not be used in cash flows unless if they have given you probabilities, then you will be using expected cash flows to calculate the payback period. Yes, I'll be doing the next question in tomorrow's class, Rida. Don't worry. If you are not being told that tax is on arrears, then you can take the tax in the same year, right? Usually the question will ask you and will tell you that the cash flow will occur in the same year or in 1 year after. Yes, the topic allocation is the first class we have done investment appraisal. Tomorrow in the beginning we'll be doing a little bit of investment appraisal, then we'll go for cost of capital and financing, and then on the third day I'll be doing business valuations, right? On the fourth day I'll be doing the working capital management. On the fifth day I'll be doing the risk management, right? And obviously some part of the work will be left behind in the year day 1 and 2, so we'll be doing it in the uh, a little bit we'll be deferring it on the next day, and in the day 5 we'll be completing the other portions as well. Risk management is the shorter portion, we'll be able to do the bit of the work pending on the day 1, 2, and 3 on the last day. Yes, students, a few formula uh, addition subtraction mistakes were happening in that above NPV calculation, which I've made the correction. Thank you for telling me. Okay, NPV function I'm not using. The reason behind it is that you won't be given the NPV function in the exam, so you are not having it, so you have to do it in detail only, right? uh, Advait, this is the answer to your question. Yes, actually it is not a risk adjusted payback, Ibrahim. It is helping us to reduce the risk by accepting a project with a lower payback. Yes, I'll be sharing all these workings in the group. Once the group is made and you people get into it, you will be getting a link, inshallah. So when you get it, then we will discuss. Then I'll be sharing these workings over there. Achha, recordings will be shared somewhere within a few days, so don't worry, but not immediately. It may take a few days, even maybe after all the workshops have been undertaken. The administration people will do it. Lease and buy decision will be done tomorrow in the earlier part. Yes, arrangement will be made to join the group. Please, you have to wait a bit for it. Huh? Please. I would request to wait for some time. You will be shared the details regarding it. Okay. There is a request to repeat the discounted payback. So what I have done, that in the discounted payback, I have taken the initial investment, 25 million first. You can see in yellow, and then I've taken these cash flows over here, the cash inflows. Due to the receiving this, I've deducted this amount from 25 million to arrive at this amount. So some amount have been recovered. Then I took this amount over here, the receipt amount, and deducted from 15.919 and arrive at this figure. And then again, I took this amount and deducted from here to arrive at this amount. So it got positive. Now what happened, that I divided this amount, which you will be seeing in blue, this blue amount, by this blue amount, which was received in year 3, right? By dividing 6.6 million to 9030, you get this 0.74, and then it was multiplied to 12 to get 9 months. So in 2 years time, the project did not pay back. After 2 years it paid back. In 2 years time the cash flow was still negative. Okay, so students, let's move on to the Bastille question. But I will take 2 to 3 minutes more, and they will end today's workshop, and we will do the rest of the work tomorrow in the next workshop. So Bastille, in case of Bastille, first we will be calculating the NPVs. So I'm not calculating the NPVs. I'm giving over here. See, we have 3 projects. Project 1, please do the NPV work yourself. Project 1, project 2, and then project 3. I'm doing the capital rationing work right now, right? So in the Bastille question, the project 1 generated an NPV of 332,740, and the project 2 generated an NPV of 57,584, right? And the project 3 generated an NPV of 4,77,000. Oh, sorry, it generated an NPV of 77,791. Okay, and the project 1, it generated 32,740. Sorry. So these were the NPVs. Now you have to try this back at your home. Please try it for tomorrow, the NPVs, and check whether you get the correct NPVs. If you don't get, please tell me. I'll give you the answers for it, detailed answers for it tomorrow. But these were the simple ones. The NPVs for project 1, 2, and 3 were as follows. And then the initial investment. The investment amount were 3 lakh for project 1, 4,50,000 for project 2, and 400,000 for these were the initial investment amounts for the projects, right? And the sum of all these three were, or the sum of all these three was 1150, right? But see, how much do they have? How much cash do they have? They just have they do not have 11 lakh 50,000 with them. They just have 8 lakh with them. So just 8 lakh with them. So how will they invest? So in case of divisible projects, what happens? In case of divisible projects, but I will end it after doing this working. For divisible and indivisible projects, it would take not more than, I think, 5 minutes. So we'll calculate NPV divide by investment amount to get the profitability index. So in divisible projects, as I said, always follow the ranking, and you know that you can purchase part of it as well. First, calculate the NPV per dollar. After calculating the NPV per dollar, you get the profitability index. On the basis of this, you will be ranking, develop a ranking. So the first rank is project 3. The second rank is project 2. And the third rank is project 1, which is generating the lowest NPV per investment. So what happens that the funds you have are 800,000, and you will start with project 3. Project 3 involves how much money? In project 3 you have to invest 400,000. So 400,000 gone. Now you are left with 400,000. 8 lakh minus 4 lakh, you are left with 400,000, and the percentage of investment you have made in project 3 was 100%. You have purchased the whole of it, but you won't be able to purchase the whole of project B. Right? You have 4 lakh, but in project 2 it requires 4,50,000. So now as the project is divisible, only due to that reason you are being able to invest in it. So 400 divided by 450,000 means you have invested just 89% in it. You will purchase a chunk of it, 89%, and full of the project 3, and your money is finished. So this is the answer to the divisible project. So you will follow the ranking, and once your funds are finished, your working ends. So first you put funds in the first rank project and then the second rank, but you didn't have enough funds to invest the full of the second rank project, so you just invested 89%. So that's the answer. So you will be using this strategy which is given in blue. Right now, if you are taking as indivisible projects, in case of indivisible projects, what happens that you will be making combinations, make possible combinations with good NPVs, and the combination with the highest NPV will be selected. So first combination can be, one of the combinations can be out of the 3 project P1 and P2. Is it possible? P1 and P2? Yes, it is possible. P1 and P2 will require how much? 3 lakh plus 4,50,000. It will require the funds of 750,000. And what will be the NPV? Add the NPVs of both of them, which is 32,740 plus 57,584. The NPVs from them will be 32,740 plus 57,584. This is the NPV that is earned from P1 and P2. Now, P1 and P3. P1 and P3 requires 7 lakh. And the investment will give you the NPV of 32,740 plus 77,791. That gives you the total NPV from these 2 projects, right? And then, is it possible that you obtain a combination of P2 and P3? Not possible, because it requires more than 8 lakh. So the best one is P1 and P3. This is the best one, the best combination giving the highest NPV in case of combination of projects trial and error method. So that's the greatest NPV which you can see in white. Okay, so that's all students for today. Inshallah, in the next class we'll be continuing tomorrow a bit of investment appraisal, and then we'll be starting with cost of capital. So goodbye, see you tomorrow. Okay, Bilal, you please try it once again. The NPV, I'll share the detailed solution tomorrow, right? Or in the group. Okay, students, I also don't myself have the link right now. Once the admin gives me the group, link I will share, or they themselves may make a group with you, no? So it will be done shortly. Okay, thank you very much, students, for attending the session, and it was a very full of pleasure session. Nice questions as well. Yes, I will do it tomorrow because today's time is over now. It's 11:30. So I'll do it tomorrow. See you. Bye bye. Welcome, welcome. I'll talk about the group tomorrow. I'll first talk to the admin as well, right? Okay then. See you. Goodbye.